What is one of Warren Buffett's most famous sayings or quotes? Well, it's his rules. His rule number 1 is never lose money, and rule number 2 is never forget rule number 1. He's all about not losing money in the stock market, but the question is, does he actually follow his own advice that he's always given to everybody else? That's what we're going to break down in this video and dissect what we can actually use from what Buffett is saying so that we can make more money in the stock market. Obviously, that's why we're all here. Now, if you've watched my videos before, you know that I have criticized Buffett a few times because a lot of the things that he says he doesn't actually do. He just likes to say these things for all the investors that follow him around like little puppies, basically hanging on every word that he says. But a lot of times he does the opposite. So for example, another thing that he always says is buy good companies at good prices. That's how you are successful in the stock market. It's like, sure, okay, yeah, you could oversimplify it like that, but if we actually look at what you're doing, because Buffett has so much power that he gets deal flow we can't even imagine. He's doing things that none of us average investors could possibly even think of. And that in itself isn't wrong, taking advantage of the position that you're in, but it's also a lot more complicated and more in depth than just investing in good companies. So that's why when one of his most famous sayings are his 2 rules, rule number 1, don't lose money, rule number 2, don't forget rule number 1, we got to break that down a little more, because if you actually look at Berkshire's stock price, you can see it here. They've had huge crashes, over 50% multiple times in their history. So what does this mean, right? If Berkshire is crashing like this, aren't they losing money? I thought the rule was not to lose money. Well, first off, there might be a difference between a drawdown and actually losing money. So the way to calculate a drawdown is from your highest account value to its lowest point. So for example, if I started out with $1,000 and I turned that $1,000 into $1,500, well, if after I hit that $1,500, my account drops down to $1,200, that's a drawdown of $300. And then the length of the drawdown, meaning how many days am I in it and dealing with it, would be from the time that I go from $1,500 to $1,200 and then back up to $1,501. So you got to reach that new high above your previous high in your account, and then the drawdown is over. So if we look at this chart of Berkshire Hathaway again, you can see, say in 2008, 2009, the company's stock price collapsed, and that would be the drawdown, right? This was the previously highest point in 2008, and by the bottom of 2009, their drawdown is reaching its lowest point. But for the drawdown to be over, we need to come back and break this highest point again, which didn't happen until when? 2014 or halfway through 2013, it looks like here. But that entire period of that many years would be the drawdown. That's the length at least. And then the depth is this drop right here, this lowest point at 2009. So that's what you would consider a drawdown. So you can see that a drawdown doesn't necessarily mean you're losing money if you don't sell. And we're going to talk about that in a second because it's very important. So keep watching because people get confused about this. But drawdowns in general are a natural part of the stock market. They are always going to happen. You can see right here the 2 examples where Berkshire had those huge dips were also when the market crashed itself. So in the 2000 tech bubble, and then over here in the 2008 financial crisis. And then even more recently, we could look at this whole CCPV crash. This was a huge drawdown, right? Albeit very short-lived, but still a drawdown. And this has always happened, just like market crashes have always happened. They'll happen in the past and they will happen in the future. Like I said, it's a very natural part of the market. Ups and downs all the time because the market is driven by what? Humans. And we're emotional, we make bad decisions, we get really greedy, and we get super fearful. So you're always going to have bubbles that pop and crash. Now what's interesting is when you look at different stock market strategies, the strategies that make the most amount of money oftentimes have the biggest drawdowns. And if you're looking at a strategy and you say, hey, that has a lot of drawdowns, what you're really saying is that, hey, that strategy has a lot of volatility, because volatility is what? The price moving up and down. So you can look at the volatility of a specific stock, say if Apple is moving up and down a lot, or you could look at the volatility of a specific strategy in a way that a person is investing. Do they make a bunch of money and then lose a bunch of money, then make a bunch again? So there's 2 ways to kind of use that volatility, and what volatility really is, or the bad part of it, are the drawdowns. So a lot of people can't handle volatility. Your average guy in the street with a 401k, he doesn't want any of that crazy ups and downs because it'll drive him crazy. And that's completely fine. But the truth is, if you could handle more volatility, strategy and bigger drawdowns, more often than not, you're going to make more money than the guy who can't. It's a weird thing that happens with markets and strategies in the market. So more volatility, more drawdowns usually equals more money if you can stomach it. But if you can't stomach it, then you shouldn't be using that type of strategy because it's going to get messed up. You're going to lose money. So it's really strategy dependent too, whether those drawdowns are okay or not. So in Buffett's case, he has a value investing strategy, right? He's trying to look for great companies at a good deal, as he always says. Well, if you're trying to look for a solid company at a good price, well then if the price of that company or stock goes down, what is that going to look like to you? An even better deal, right? So for a value investor like Buffett, when they see a drawdown in a stock, they're looking at it differently. They're thinking, hey, maybe I should be buying more. But this mentality can be extremely dangerous, especially if you don't know what you're doing. And we're going to cover that in a second, so keep watching. And by the way, if you like this video, make sure you hit that subscribe button, because I could look at the stats of these videos and kind of see what people are liking, and I'll make more of those videos. It really encourages me to do that. So hit that subscribe button if you haven't already. Now let's talk about that big flaw with that value investor mentality that Buffett and other value investors might have. So this whole idea of a drawdown and a price looking more attractive to you because the company is cheaper, this becomes very dangerous, because what you're doing is basing your analysis of a stock purely off the company's fundamentals. So hey, they have earnings of this much, revenue of this much, they are a good company regardless of what the stock market is doing to their share price. And that might be okay when you're as experienced as Buffett. But when you're not, and the stock market is telling you, hey, this company is not good, which is why it's pushing its price down, instead of you saying, hey, no, I'm right, I know more than the stock market, you should probably be saying, oh, I might be wrong here. And that's when we get into the discussion of risk control, which is so important in the market. And another way to look at the quote that we're dissecting here from Buffett, don't lose money, is all about risk control. But it's just another weird thing because Buffett talks about it, but in his strategy, he doesn't actually practice it in the same way that you or I would. So risk control, when it comes down to it, is just protecting your money in the market. It's cutting your losses when you need to and making sure that you don't lose all your money. You don't want to blow up your account. Now, risk control, when it comes to a value investor, they think in terms of a margin of safety. So they're using a fully fundamental based risk control. And a margin of safety is basically saying that, hey, I think the company is valued at this much. I think the price should be this level. So even if the actual price the stock market is valuing at drops, as long as it's above that level, that's okay, because I think the price is worth more than that. So the price can drop all it wants and that's fine. I'll just buy more. It's a better deal. The only time they end up selling is when the price is higher than what they think it's worth. So again, it's all based off your analysis, which can be dangerous when you're not experienced, because oftentimes you're going to be wrong. The market might be fully correct in trashing the price of the company that you analyzed. You might have gotten the analysis wrong. So the scary part is when you think instead of selling because you are wrong, you should buy more. That could really hurt you because you end up buying into a company that's collapsing and you're going to lose more and more money. And the second thing that could be really bad is when an investor takes this whole idea about drawdowns and twists it. And I'm going to tell you what a lot of investors do, and it's so backwards, but for some reason we all do it when we start out, so keep watching. So we explained that a drawdown is when the stock falls but then recovers, right? Well, sometimes a stock does not recover. The stock keeps going down, down, down all the way to zero. So if a person says, hey, a drawdown is just fine in the market, and they hold on thinking that it's going to come back, and they keep holding all the way down, and they start saying, hey, I'm not going to sell because as soon as I sell, I'll take a real loss. And that's another thing about the stock market. You can have paper losses and then you could have real losses. So if you bought a stock for $10 and now it's at $5, on paper, you lost 50% of your initial investment. But you don't actually claim that loss until you sell the stock, right? So what a lot of people think is like, hey, instead of selling the stock, let me just hold on to it until it comes back. It's going to come back. And then this whole period going from 10 to 5, it was just a drawdown. Sometimes that's true, but more often than not, the stock can drop to 5 and stay there for years or even go lower. And then you're the bag holder with a stock that's trash and you're just holding on and hoping. That's the worst thing you can do. Just sit there and hope. And in the back of your head, you're thinking, oh, as long as I don't sell, I'm not going to actually take this loss. And that's just the wrong mentality. And that's why when we look at Buffett's rules not to lose money, and then we look at what he actually does with his margin of safety value investing, it gets a little confusing because if we try to do the same thing, we could get really screwed. So I prefer to follow his advice a little more literally with my risk control and the strategy that I use. And this is a strategy I use and a lot of our Fallible members use as well. And what we have in place are something called stops. So what happens is if a stock hits a certain certain price point below where we want it to be, then we're going to sell that entire position. And yes, we do take a loss, but the idea is that we take a smaller loss now to avoid the bigger loss later. That's the whole idea behind stops. And yeah, sometimes the stock turns around and goes straight up, and then it would have been a drawdown. But like I said before, you can't always depend on that, because what if the stock didn't turn around? What if it kept going lower? We're much better off selling before a small loss turns into a big loss. And that's how we control our risk. That's how we don't lose money. So I'll give you an example of what happened recently. In a previous video, we were talking about how the stock market absolutely took off after this Biden win, and then there was news about a vaccine for the CCPV. Well, look what happened. The stock market spiked and came all the way back down. And at the same time as the stock market was spiking because there's a vaccine and a Biden win, work from home stocks like Zoom and DocuSign, they got hit hard. And the whole idea is that, hey, if we have a vaccine, why do we need technology anymore? Like, people are going to go outside and go meet people. They don't need Zoom anymore to have video conferences, which is very stupid short-term thinking, but that's sometimes how the market reacts. So in this situation, like I explained before, our strategy has stops in place. So if these work from home stocks that we're invested in continue to fall, we're eventually going to sell them as soon as they hit that level where we don't want to own them anymore. And that's how we keep our losses small. We only lose a little bit of money, lose a little bit now to prevent the large loss later. And like, if we look at a company like Zoom, what's likely going to happen is it's going to go down and then come straight back up. But we can't possibly know that. What also might happen is that it keeps going down, 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 down 50% and then stays there for years. You never know. That's why you need to cut your losses. You need to have that risk control in place. And actually, literally as I'm recording this video, I just got an alert on my phone that DocuSign actually did just hit its stop point. So after I'm done recording this video, I'm going to go sell it. And guess what? I am going to take a loss on DocuSign. And now our strategy, which was previously up 60% this year, is now only going to be up 53%. So you could say it's a drawdown in the strategy, because our high point was a 60% return. Now we're at 53%, and the drawdown will continue until we get to, say, 51%. Now, of course, no one likes taking a loss, but you got to go back to Warren Buffett's quote: don't lose money. Prevent yourself the pain in the future by selling now. And sure, it might suck in the moment, but you know the last time we did this? The last time we were selling was when the stock market did this in the whole CCPV shutdown. When it collapsed, we were selling, and what we did was we ended up cutting our losses before we had to take the brunt of this big crash. And that's why when we look at our results now of our strategy, we're way above the market. We're beating the market by a lot because we didn't take those same big losses that the market did. We cut them. We managed our risk. So it always sucks while you're doing it because you don't want to sell, you don't want to take a loss. But then you look back a few months from now and you're like, oh God, I'm so glad I did that. And that's why I'm beating everyone else now. Now, if you want to learn more about this whole strategy that I'm talking about so you could use it yourself and use the same risk control that Buffett is talking about, but a better version, at least for you and me, then definitely check out this free training. I'm going to put a link in this video and down below in the description and comments. It'll teach you exactly how we do it. A bunch of our Fallible members are using it as well. And we even have alerts like I was talking about that I just got on my phone during this video. And also, now that you've watched this video, you should definitely continue to watch the rest of our Buffett videos that goes over a bunch of lessons from him in this same way. There's a lot to learn from him, but we kind of got to take it and mold it into what works for us because we are different. We are not Warren Buffett. We don't have the same advantages of him. And this set of videos will show you exactly how to do that. So in a few seconds here, there will be a screen that pops up that will show you the training that we just talked about and this playlist of videos about Buffett and what we can learn from him. Definitely continue on to watch these videos or take the training. Both are very valuable. But before you get to that, I know some of you wanted a puppy update. So here's Luna growing fast, you can see, just getting huge. Recently, she went to Target and bought herself a little sweater. Trying to get super basic, I guess. Maybe we should change her name to Becky or something. Look at this sweater. Target sweater. Oh, classic. Most likely after this, we're going to go do some yoga, maybe get some brunch. Sky's the limit. But maybe we'll just take a nap, I guess. But that next screen is coming, so make sure you watch that playlist or take the training, and I will see you in that next video. So click away. I'll see you there.